and jump right into the presentation. I've got about 30 minutes of material that I want to cover, and feel free to chime in with questions if you want during the presentation, or just wait till the end. I know in these type of group settings, people don't want to kind of ask questions because they don't want to be embarrassed. But luckily on Zoom meetings, you can just ping in the questions to Lexi, and Lexi, you can then ask me those questions that they come in, and you'll be totally anonymous. So everybody else won't know what type of questions you're asking. And honestly, you know, growing up, your teachers always taught you, you know, there's no such thing as a dumb question. And I tend to agree with that because people are coming from different backgrounds and have different knowledge sets. All right, so let's jump right into, let's see here. My first slide, which is not my favorite slide, but my legal department requires that I show this. Can you see this okay? All right, perfect. So yeah, the legal department requires us to put this out there just in case somebody in the audience is from the SEC or FINRA, or should you decide to sue me later on, I am covering my bases. So with that being said, let's jump right into the meat of the presentation, and that is 3 objectives I want to kind of cover today. Where are the markets today? The pitfalls of investing and investment frameworks. Now, where are the markets today? We're going to briefly kind of cover, and then the bulk of the presentation is going to be on pitfalls of investing and then the investing frameworks. Okay. So yeah.
Sorry to interrupt you. We can see the your other yep, there you go. You got it. You did it.
Let's see.
It's on the comic right now, if you can see that.
You're on the comic, right?
Well, now we're on your face.
All right, hold on one second. You still have the comic up, I'm assuming, right?
Yes, yep. Can you arrow down?
Yeah, that's what I was trying to do. There we go.
Oh, there you go. Perfect.
Does that work? Okay, so the objectives, again, real quick. Where are the markets today, the pitfalls of investing, and then investing frameworks, right? Most of the time is going to be spent on number 2, the pitfalls of investing. And then, again, we'll try and wrap up with the investing framework. So getting kind of right into it, you can see on this slide, the market high was reached February 19th. From that high to where we closed at yesterday, we're only down about 16%. I say only because at the peak from the top to the bottom, we were down roughly 34%. So we've gained some ground back in the last couple of weeks. And then if you look at it on a year to date basis, so if you had started investing at the beginning of the year, going until tomorrow, you're still down about 12%. So the question kind of is, why is this happening? Well, markets in general don't like uncertainty. And obviously, as Diane said earlier, these are uncertain times, right? And the market is still trying to grapple with how long and how deep this economic slowdown is going to happen. And until they get some clarity on that, we're going to have some volatile days, both on the upside and downside. Yesterday was a fairly good day. Today we started off pretty rough. And again, what the market is trying to grapple with is just how long this economic slowdown is going to happen, how deep it's going to be, and then they can model out, you know, how the revenues and profits are going to be affected. And the reason they want to model those out is that is what drives stock returns in the long term, right? And right now, since we don't have a good input on the front end of the model, you're going to see quite a bit of volatility with that being said. So, you know, how do you invest during uncertain times? Well, I would point you to the golden rule of investing. And I think everybody is fairly familiar with this. It's the simple adage of buy low, sell high. Unfortunately, it's not that easy. And if it were that easy, we wouldn't be having this presentation, obviously. But the data actually shows that it isn't that easy. And the reason that is because we as investors are just very bad at investing. And we'll go over some of the reasons that is, but some of the data behind this is based on one of these slides that I put in here. This is a JP Morgan slide. If you are a do-it-yourself investor, you can go to JP Morgan's mutual fund website and actually get this resource for free. It's, I think, roughly 150 pages of just great information on the markets, fixed income markets, international markets. I think you can have them push it out to you on a quarterly basis. But again, it's a great resource for do-it-yourself investors at home. Just go to JP Morgan's website and search for a guide to the market. So going back to the slide, I want to kind of bring your attention to the bottom part of the slide, the 20-year annualized returns by asset class. This is compiled by a company called Dalbar, and they are an industry research firm. So you can see on here over the last 20 years, from 1999 to the end of 2019, had you invested in real estate investment trusts, that's REITs, you would have averaged about 11.6% rate of return on an annual basis. Okay? And that doesn't mean that you got 11.6 year one, 11.6 year two, et cetera. It just means if you held it over that entire period, your average return would have came out to 11.6. Now the S&P 500, which presumably is the best gauge of how the market overall is reacting, has averaged 6.1%. And what I want to draw your attention to is the second to last bar, which is the average investor. The average investor, according to this study, averaged 2.5%. Okay, and the way they kind of calculate this is they look at money moving into and out of the markets, and they come up with this generalized number. Now, personally, I don't subscribe to this low of a number, but I've seen many other studies, and all of the studies essentially show that the average investor trails the market, okay? Now, why is that the case? Well, the reason we're not really good at investing in the markets is really how our brains are wired. We are not wired correctly in following that golden rule, buy low, sell high. And that's because we have these biases. So one of the famous people or groups of people that wrote about this is Danny Kahneman in his book, Thinking Fast and Slow. If you read that book, it's a pretty hard read, it's pretty long, but essentially he was one of the founders of what's become known as behavioral economics. And in the book, what he describes our thinking as is it's a system one and a system two type of system. And system one is the quick reacting system of our brain. It is what we engage when I ask you the question 2 + 2. So we don't really have to think about the answer to that because our brain has that ingrained in there, and system one kicks right on and says, hey, 2 + 2 is 4. We have another system called system two, and the way he describes that is that's the more lazy part of our brain, but it is the more rational part of our brain and also the more meticulous part of our brain. So if I ask you the question 250 times 322, well, that's what kicks on system two, okay? But in general, our brains are working typically on system one. Even when you're driving the car, you know, if you remember when you were just getting your driver's license, system two was working really hard. But now, as you've developed the intuition of how to drive the car, system one takes over. Now it's kind of second nature, okay? And so when we make decisions, typically our decisions are based on system one thinking. And with all the information that we're bombarded with on a daily basis, system one develops these biases or rules of thumb. So a bias is essentially mental shortcuts, and they're put there so that we can make decisions in a quicker fashion, in a more efficient fashion, again, based on how much information we're being loaded with. So over the years, since the famous paper called Prospect Theory by Danny Kahneman and Emil Tversky, psychologists and behavioral economists have come up with hundreds, if not thousands, of different biases. I'm just going to talk about two particular biases today, which I think kind of hampers our long-term success in investing. And that's recency bias, which also can be known as availability bias, and loss aversion, okay? Simply put, recency bias is our tendency to look at what's happened in the most recent period and then project that going forward. And I think a couple examples will help kind of nail down the concept of this bias. So if any of you have been into a casino, one of the famous games at the casino is the roulette table, right? The roulette table is essentially they throw a ball on this little table, spinny table here, spin the wheel, the ball falls on a number, and if you'd bet on that number, you would win some money. You can also bet on the color, so whether it lands on a black color or a red color. Now, every casino you go to will have this board behind it, the picture on the right, okay? And the casinos are actually well aware of this bias in people, and so that's why they put that board up there. And what typically happens when gamblers go there is they will look at the board, and your brain, your system one kind of clicks on, and it looks at the board to try and find some type of trend or some type of pattern. Because again, our brains are wired to try and find patterns of events that happened in the recent past, and then use those patterns or those trends to kind of forecast what's going to happen into the future. Now, mathematically speaking, the next roll of the ball doesn't know what the previous rolls were. It doesn't know what the numbers were previously. It doesn't know what colors they were previously. So each roll is actually independent of what happens in the past. But our brain wants to think that we can kind of figure out the trend, right? So that's one example of recency bias. Another example, if you've never been to a casino, is if you ever played the flip of the coin game, right? So a guy flips a coin 5 times and then asks you what the next flip is going to be. And usually, again, there's some type of bet involved. But you will look at those first 5 flips and try and figure out a pattern. Maybe the coin is weighted differently in the sense that, hey, heads typically comes up, or maybe it's heads, heads, tails, heads, heads, and then you might say tails, right? Again, when that guy does the flip on the 6th turn, the coin doesn't know what has been flipped previously. It's an independent bet. It's a 50-50 chance that it's going to be heads or tails, essentially, okay? So that is one bias that we're faced with when we actually invest. So typically what happens in investing, and we see this all the time with clients, is we take what has happened in the most recent past. So the market goes up, you know, we think that the market's going to continue to go up, economy's doing well, et cetera, et cetera. We'll typically add in more money, or we'll buy in at this point. Inevitably, the markets always come back. There's a cycle to it. Markets come down. Your brain looks at it and says, well, the markets are going to continue to go down. There's a pattern here, and then they sell out. So what has happened in this situation? You waited for the market to go up. You bought in at this point. Market inevitably comes down, and then you sell out at this point. So you've done the exact opposite of what you should be doing, buying low, selling high. In this case, what you did is you waited for the trend upward, you bought in, inevitably the market comes back. Now you think there's a downward trend and you sell out. So you bought high and sold low. So that's one bias that you want to be aware of when you're thinking about investing. Okay, the second bias that we're going to talk about is loss aversion. Now this framework was kind of known about previously, but again, Danny Kahneman and Amos Tversky wrote a seminal paper called Prospect Theory, and this is what really launched behavioral economics, okay? And what loss aversion is simply put, our tendency to feel more pain and losses than pleasure and gains. And again, I'm going to use an example to kind of nail down the philosophy behind this bias that we have. And it happened to me, okay? So a few years back, my wife gave me a $100 gift card to Macy's for my birthday, right? So I opened the card up. There's a nice little card, $100. Hey, great, you know, kiss my wife on the cheek and off we go, right? A few months go by, I go to Macy's, I'm buying some shirts, and I open up my wallet and I can't find that card. Well, not a big deal. I probably just misplaced it, put it at home, whatever it is. Drive back home, go in my closet, look around a little bit, not a big deal, can't find it. Again, probably it's at work. Next day, come to work, I start looking in my desk, start looking around here, trying to find that $100 gift card. I can't find it. Okay, maybe I put it above the microwave at the house. So I go back to the house, and again, I'm kind of searching the house. I'm literally trying to, you know, find this $100 gift card, which in my mind now I'm thinking I literally lost $100, right? So this is the premise of loss aversion. The pain of losing that $100 was more than the satisfaction I felt of receiving that $100, right? And so Amos Tversky and Danny Kahneman actually came up with this graph that you can see here on the right. And they actually did a mathematical formula. And kind of to explain this, if you look at the graph, you can see if you received a $100 gain, you go up the y-axis, and that gives you about 1.5 units of psychological value. If you go to minus 100 and go down the y-axis, you see that you have three units of loss in psychological value. So what they're saying here is if you gain $100, you have about a 1.5 units of happiness. If you lose the same $100, you have about 3 units of displeasure, or in this case, pain, right? And this really comes into play. So in investing, last year the markets were up, or the S&P 500 was up a little bit over 30%. Now, I didn't receive a single phone call from my clients. I didn't receive any gift cards in the mail. I didn't receive any pats on the back when the market was up over 30%, right? Now, I myself didn't cause that, but your statements reflected a 30% gain, right? Come March, end of March, markets are down roughly 30%. You can bet that I was on the horn for 10 hours a day, if not on the phone. I'm in the email trying to respond to client concerns, right? Again, the gain is a lot more painful than the losses are a lot more painful than the gains we have. So that's kind of a loss aversion in a nutshell. And kind of before I move on, I want to get into a hypothetical here for you guys and kind of tie some of these concepts up. So let's say you come to me and you want to invest some money. So I'm going to give you 3 options. You got bucket A, bucket B, and bucket C in this option, right? And you can say in bucket A, I will tell you that the best return you can get out of bucket A is 47% on the upside. The worst return you'll get on bucket A is minus 39%, right? Bucket C, the best return I'll give you is 43%, on the downside minus 8%, and then bucket C is a plus 2% gain or no loss at all, right? Now, most rational people would pick bucket B or C, right? Who wants to suffer a 39% loss? Not me. So I would opt for either bucket B or bucket C, and depending on where you're at in your life cycle and your upbringing and all that, you could choose between those two, right? And again, that's the rational choice. Now, before I have you invest, I show you another graph. Option 2 is bucket A gets you a high return of 17%. The lowest return it's got is 6%. Bucket B is 12% on the top side, 1% on the bottom side, and then bucket C again is 2 to 0%, okay? So in this case, which bucket would you pick? Most people would choose bucket A because that gives me the best range of return, right? 17% on the top side, 6% on the bottom side. Now, the reason this is important to our conversation is bucket A in both of these situations is actually the same thing. So bucket A is represented by stocks, bucket B is represented by bonds, and bucket C is essentially a hypothetical savings account. The only difference between the two graphs is the time frame. So again, reverting back to JP Morgan's slide, I pulled this from their information. In graph 1, option 1, those were the return ranges since 1955 of 1-year returns, okay? So if you had gone back to 1950, your best 1-year return was 47% in the stock market. Your worst 1-year return was minus 39% in the stock market, okay? Option 2 is based on a 20-year time frame. So if you held stocks for 20 years between 1950 to 2019, and this is a rolling return, your best 20-year return would have been 17% on an annualized basis. Your worst case scenario, holding stocks for 20 years, is 6% annualized return, okay? So bucket B, again, is bonds. So your best return in bonds is 12% on an annualized basis. Your worst return was 1%. And then bucket C, again, is just a hypothetical savings account, right? So if I show you these two investment options and you're planning on retiring in 20 years, it's kind of a no-brainer, right? You would want to have more of your money in stocks because over a 20-year period, that gives me the best option for return in the market, right? So why is that the case? Why is it the case that stocks actually give you the best return in the market? And what one of the things I talk about with my clients, again, this is on a long-term time frame, and we'll talk about what I think is going to happen in the short term. But on a long-term time frame, the market is driven by human nature. And what do I mean by this? So the first thing I want people to recognize is that it's not a stock market. The stock market isn't this crazy entity that's out there. It's actually a market of stocks, right? And what that means is there are companies listing on the market, and you as a stock buyer, when you buy their stock, become owners in that company. So how does that company make money? That company makes money by selling goods and services to the public, right? and hopefully above and beyond their expenses. That's how they make a profit, right? So how do they sell goods and services to the public? Well, this is where I think human nature kind of comes into play. So human nature, it's actually in our nature as humans to be social creatures, right? We tend to want to be in groups. We don't want to be isolated. That's why this whole, isolation thing is breaking a lot of people down, both mentally and physically, essentially, because we want to be around people, right? We want to be in groups. We want to go out and spend time with our friends and family. Probably family not so much these days since we've been stuck with them for so long. But in general, you want to be mingling with other people, your peers, your colleagues, again, your friends and family, right? And one of the ways we choose, especially in our society here in the US, one of the ways we are able to gain acceptance into a peer group is through our purchasing behavior. So, you want to go out and buy the best car you can afford, right? A Mercedes-Benz, to be able to show that off. It's the notion of keeping up with the Joneses, right? I guess today it's actually keeping up with the Kardashians, although they have too many cars. But that being said, we always want to try and keep up with the Joneses. The neighbor goes and builds a swimming pool. I probably should build a bigger swimming pool, right? Guy across the street goes, buys a nice car. I'm going to try and maybe one-up him. And the reason we do that is because, again, we want to be accepted. We want to be able to show that we have wealth. And with that wealth, we believe comes power, right? So the consumption pattern is always there. We are a consuming society. In fact, roughly 70% of our GDP is based on consumption alone, right? Just us going out and buying goods and services, essentially, right? And when you buy those products, you're buying products from companies. And most of the time, those companies are listed onto the market, right? So you go out and you buy a Coke or a Pepsi, you're giving money to that company, and somewhere down the road, that company is going to send those profits back to the shareholders, the stockholders, right? The example I've been using right now is Charmin, right? Everybody knows nobody's not ever going to buy toilet paper, apparently, right? Charmin's owned by Procter & Gamble, okay? Tide, owned by Procter & Gamble, right? You're going to go to McDonald's eventually. You're probably going to buy, a new car eventually, because cars just by nature break down, right? So my rationale for stocks for the long run is just based on human nature. Now, if you believe that people are going to stop buying things in the long run, so I'm talking like 3, 5, 10 years, on an extended period, then yes, the market's not going to work, because those companies aren't going to create revenues. Those companies aren't going to create profits. And guess who gets wiped out? The shareholders. But if you believe in this human nature, the fact that we as human beings want to be socially accepted, and one of the ways we do that is flaunting our wealth. And I say flaunting our wealth, I don't want to say it in a negative term, but we have certain needs regardless, right? Housing, clothing, food. Again, companies are all selling that to us, right? If you believe in that concept, then yes, the market will work in the long run, okay? If you don't believe in the concept, then you have every right to say, the stock market's not going to work, okay? Now, we might reduce our purchases, we might delay our purchases, but at some point in time in the future, we will continue to go back to our old selves and go back to McDonald's 3 times a week, or whatever it is, right? Go to the gym, keep buying toilet paper, whatever consumption pattern you had before all of this happened, okay? It's just human nature. So with that being said, let's move on. Lexi, do we have any questions here? No questions. Okay, so either everybody's engaged or everybody's logged off at this point. So let's look at the investing framework. So again, we talked about why I believe stocks are kind of a good thing in the long run. And one thing I want you to take away from this is, hey, don't go out and buy a bunch of stock, right? Like, there's other things that come into play here, and that's what I'm going to talk about next. It's time frame. You want to look at, what is your time frame in investing? So, you could have a time frame of 1 year, 3 year, 5 years, 10 years, 20 years. Now, I have clients that are in their mid 50s come in, or in their early 60s and come in and say, hey, our time frame is 5, 10 years. And I have to kind of refocus the situation and say, really, your time frame is longer than what you think, because you are going to be investing this money not for 5 years or 10 years. You're not going to just 5 years from now take all your money out and run with it. You're going to have to live off that money, right? So your time frame is extended to your life expectancy, not just your retirement date, right? So there is a concept of, hey, dialing down your risk as you get to retirement, and that's a valid point. You don't want to dial it down so much that you're 65 and you're going to live to 85, and you've got 20 years of income that you have to draw from this bucket, and you put all your money in some safe asset, right? Just because you didn't want to deal with the volatility, this thing called myopic loss, which I kind of glossed over, I'll go back to, but you essentially need to really dial in your time frame. Now, when people come in and say, hey, I have a 1-year time frame, I want to give you some money, invest it for a year or 2 years or 3 years, I'm very hesitant to invest that money in the stock market. And the reason that is, the stock markets are typically driven by 2 factors. One is sentiment, and 2 is fundamental. So fundamentals essentially is the earnings of that company, the economic growth that's happening in the country. That plays out over long time periods. So that plays out over 6, 7, 8, 10 plus years. Sentiment is driven by these biases. So right now we're in a sentiment environment, and that moves markets in the short term. So we literally have this thing called risk on, risk off days. So some days will come in and the market is selling off, like today, just because everybody wants to get rid of their risk, right? Now, fundamentally, nothing has changed. So, Coke is still selling the same amount of Coke they did last month, but now people don't want to own stocks just because my system 1 has kicked in at this point, and I just don't want any risk on the table, right? So when you try and invest in the short run, there's a lot of hiccups there. You really don't want to try and play the averages, so to say, because sentiment will drive returns in the short run. And on the flip side, market was up almost 2.5% yesterday, right? Why was that? I don't know. There wasn't any major news that came out yesterday and said, hey, markets are back to normal, okay? It was just a sentiment change that happened, and that happens on a daily basis, okay? So when you're looking at your investment portfolio, the first thing you want to look at is time frame. The second thing is risk tolerance, okay? I call this the phone call test with my personal clients. I say, if you put in $100,000 today, at what point are you going to pick up the phone and call me because you lost some money? Is it if that 100,000 goes to 90,000? Does it go to 80,000? Does it go to 70,000? And kind of gauge your risk tolerance based on that. But what typically happens is you receive a questionnaire, 5 or 10 different questions that you're supposed to answer. And these are hypothetical situations. Excuse me. Hypothetical situations that we're trying to gauge how you're going to react. Now, these questionnaires, there's many out there. You can go online and find a risk questionnaire just by Googling it. I tend to think these aren't great ways of trying to gauge risk tolerance. And the reason that is because imagine you are going to flight school, right? And you go through all your book work in flight school, and then at the end of all your book work, you have to take your final exam. Well, the final exam is being able to prove you can fly the plane, right? So they'll take half the class and put them in a flight simulator, and they'll take the other half of the class and put them in an actual plane, right? So the people that go in the flight simulator are going to be a little bit more aggressive. They might go a little faster. If they throw some type of curveball at them in the simulator, they might be a little bit more aggressive in how they approach that. Whereas if you have guys in a real plane flying around, they're probably going to be a lot more conservative, right? And if they throw some type of situation at them, they're going to try and go as much by the book as possible, and they're going to try and be as conservative as possible because it's a life or death situation in that sense, right? So when you're filling out a risk tolerance questionnaire, it's kind of like that flight simulator. It's just a hypothetical, right? And we might know how we're going to react to that thing at that point in time, okay? But when you're in the actual plane or an environment that we're in today, right? So you can think literally what happened in the month of March where we lost almost 30% of the market. How did you react? Were you panicking? Did you move money out? Did you put more money in? What was your reaction in that time frame? And were you watching the markets every day, right? So that gives you a better idea of how you want to allocate your overall portfolio. And those are the two main things that go into portfolio allocation. Whether you go to me or whether you go online, a lot of 401ks have an allocation builder on their website, and they really just pull from these two markers. What's your time frame and what's your risk tolerance, right? So that being said, kind of to wrap things up here, I know I'm going over a little bit. Wrapping things up, again, I believe human nature drives the market. Again, it's just us buying goods and services. So if you believe that people are going to stop buying goods and services 2, 3, 4 years down the road, then yes, market's probably not a good place for you to be. But we also react to the market based on our human nature, right? And some of these biases, there's so many different biases that we can talk about. I just want to kind of keep it clean and simple. So these are kind of the two main ones that I see people locked in on. The recency bias and the loss aversion bias. You know, we don't want to take losses, obviously, in the short run, but really you have to focus on the long run. Those short-term blips are derailing our long-run returns, right? If we go back to those two charts I showed earlier, you know, the stocks give you the best opportunity on a 20-year time horizon, right? And you know, I think Warren Buffett said it best. His famous quote is, "Be fearful when others are greedy, and be greedy when others are fearful." Right? And it's the exact notion of the investment principle: buy low, sell high. But you know, when the house is on fire, our system one kicks on, and we don't necessarily want to run back into the house to get the cat or whatever it is, or in Diane's case, John. We want to run from the house, right? Because that's just how our system one is. But in investing, you need to kind of block out system one and really think about what's happening in the markets, okay? That's really all I have for you. I can tell you, you know, again, I don't know what's going to happen with stocks in the short run. I have my inclinations of what's going to happen. But what I do know is we've been through these types of periods before, and every single time the market has come back, okay? And the reason the market has come back is, like I said, people go out and continue to buy stuff, whether it's 2 years from now, 3 years from now, 4 years from now, whatever it is. People just have the human nature to go buy things. And every time we've been in an economic collapse or malaise or whatever you want to call it, especially in this country, we've always made it through, and we've come out stronger on the other side. So with that said, that's the end of my presentation. I don't know how long I ran there. I probably rambled on more than I thought I was. But if you have questions, Lexi, you want to open it up for questions, or if we had any questions come through while I was ranting and raving?
Yeah, feel free. Sorry, Diane. Yep. I was going to say, feel free just to unmute yourself and talk, or you can put it in the chat box if you don't want everyone to know what you're asking. So either way, that works.
So Kris, I have a question for you.
Yeah.
We're talking about, you know, buy low, and I don't know if you want to expand on maybe when you see kind of your projections, what will happen when COVID-19 restrictions are uplifted, but seeing that, you know, the deadline for contributing to like a Roth IRA is extended, you know, from April 15th to July 15th.
Yeah.
What is your guidance in when you make your contributions? So say I'm going to, you know, make my maximum contribution to my Roth IRA. Should I be making that now? Should I be waiting till July 15th? Should I do a combination?
Sure.
Do you have suggestions on that?
That's a great question. We're hearing a lot of that right now, right? So again, it kind of goes back to your risk tolerance and your time frame. That being said, our personal projection is that we will drift a little bit lower. One of the things you want to focus on is the market is forward-looking against the economy. So the market will go down before the economy technically goes into a recession. And on the flip side, the markets will rally before the recession ends. And there's been some studies on this, and the studies show that on average, the markets will start to go down about 6 months, about 5.5 months before a recession starts. And it will climb or, you know, hit the bottom roughly about 5 months before the recession ends. So again, going back to the first thing we were talking about, right now the market really doesn't know kind of where the recession points are going to be, because we don't know how far and widespread the virus is, and also how long the economic shutdown is going to be. That being said, what I focus clients on right now is saying, look, you know, you want to add some more money, that's fine. We like where valuations are, not so much this week, but you know, a couple weeks ago we were okay with the valuation. But if you have a time frame, what do you like, 35, 40, Diane? I mean, you got like a 30-year, 40-year time frame, right? So whether you save 5% on the downside.
Are you talking retirement or my life expectancy?
Retirement. You look so young, Diane. Again,
okay, say somebody's in their early-ish 50s.
Yeah. Okay. So again, so early-ish 50s, let's say. So how long is your time frame? Your time frame is like 30 years. Okay. So whether you put money in right now and then say, you know, clients will say to me, well, you do believe the market's going to go down, so I don't want you to invest it right now. Why don't you hold on to it and we'll wait for the market to go down? So that I ask the questions, two questions to clients at that point. I go, well, okay, you need to give me a marker on how far low or how far down the market has to go before I put that money in. Because honestly, I don't know where the low point is going to be. And in fact, nobody can pinpoint where the low point is going to be. If they could, they'd own a bunch of islands, right? Like it's just impossible to tell when the low point is going to be. So we tend to focus on valuations. So in your particular situation, to answer your question, I don't want to ramble on again. I would say, hey, take 50% or 25% of that money you plan on contributing and go ahead and put that in the market, okay? Because the risk you run into is you could put the money in the market and say, hey, I think the market's going to go low. What if the market never goes low at that point, right? And the market just runs on you, okay? This happened last year. The market just ran like 30%, just straight up. I mean, there were no like major dips last year to be able to jump in. And why was that? Well, fundamentally, there wasn't a whole lot of things that really pushed the market straight up, okay? It just happened, sentiment, like I said. So I would hedge the bet and say, take 50%, go ahead and put it in the market. Again, because the main question you want to ask is, where's the market today? Where is it in 20 years from now? And 20 years from now, 100% of the time, even going through the Great Depression, going through the technology bubble, the Great Financial Recession, 100% of the time, 20 years from now, the market is up, okay? So that's the question you have to ask is, if I put money in today, where's it going to be in 20 years? In all likelihood, I shouldn't say guaranteed, otherwise somebody probably come and sue me in 20 years, but if the market's not up. In 20 years, historically speaking, it's always been up. And that goes back to that notion I was talking about, human nature, just buying stuff and those companies making profits, right? Now, one thing that can happen is you buy in now, market drifts lower, and then what you're going to tend to do is you're going to get into this other bias known as anchoring bias. I don't want to go into that, but the example I've been using with clients today is let's say you're planning a vacation, right? I know a lot of people aren't doing it right now, but assume last year we're planning our spring break vacation in December, right? So you say, what do? You go online, you try and look at airfares, and you say Florida's fairly cheap, and you're gonna buy a plane ticket to Florida, right? Now the price of that plane ticket from the point you bought it, let's say you bought it in Christmas to spring break, is gonna fluctuate, right? It's gonna go up and down. You can't time the best time to buy the plane ticket. And this is kind of how you have to look at this. You shouldn't worry so much of where the market is in between. The thing you need to worry about is where it is from today to where you're gonna actually use the money, right? And it's gonna fluctuate in between. Again, if I knew the answer of when you should invest, I wouldn't be talking to you guys.
Right.
Okay, so you could hedge your bet, like I said, put 50% in, wait for some downturn. And really what I tell clients is I put it on them and I say, look, you need to specify a level that you want to get to. Because what typically happens is, you put in at this level, the market goes down, and then initially you said, hey, I'm going to wait for the market to go down 10%, I'm going to put money in. Well, when the market goes down 10%, system one turns on at that point, and now you get into this recency thing and you start to say, oh, the market can continue to go down at that point. And you don't actually pull the trigger and invest in that point. You continue to wait, but then it turns on you, right? And then it shoots back up and you missed your buy-in point, so to say. Okay? So to answer your specific question, I would, at this point, hedge the bet. Again, what we're forecasting is in the short run, we think it will drift a little bit lower. But again, if you have a 20-year time frame, I'm not concerned about, trying to save 5% because that all meshes out over a 20-year time frame.
You're encouraging everyone to, if they're able to, do the max that they can in their IRAs too.
Oh, absolutely.
Okay.
Yeah. Now, to your point though, you don't have to, you can put the money in right now. You don't have to invest all of it right away, right? You can, again, put 50% in the market, 50% in bonds, and it's going to be based on your allocation, right? Nobody in theory, unless you're, under 30 should, really have 100% stocks in their portfolio unless you're super aggressive. That being said, I have clients that are that way. So it just depends on your risk tolerance.
Okay.
Kris,
Thanks. Good information.
Are you able to see the chats? You have a few in there, but I can read them to you if you would like.
Yeah, could you read them? I'm not really sure.
No problem. Someone asked, is your company predicting a recession then?
Oh, we're already in a recession. So I don't have to predict that. We are in a recession right now. And all the major banks have come out. Now, we read all the reports from all the major investment banks, and conceivably they are all saying this is going to blow over in the third and mid-third, beginning of fourth quarter. So they are estimating that the recession will be through this second quarter and then would dissipate into the third and fourth quarter, essentially.
Okay. Someone asked, thoughts on inflation or deflation, especially with trillions of stimulus injection?
Wow, that's a great question. So look, the governments have thrown out, the federal government has thrown out close to $2.2 trillion into the economy. The Federal Reserve has thrown out, I think the number at this point is roughly $6 trillion. That's a lot of money floating out there. And basic economics would say, if you increase the supply and demand goes down, the price of that thing goes down. And in this case, the price of the dollar goes down, which leads to inflation. So this kind of, this same situation happened in 2008 with the Great Financial Recession. We threw a bunch of stimulus out there, if you remember the TARP money, the bailout money, stuff like that, and we never ignited inflation. So two things need to happen with inflation to catch a hold of. And I'm not going to answer the question specifically. I'm going to give you how to think about the question, and then you can answer it yourself because, again, it's difficult to predict. So the way you can calculate inflation is supply of money, which we know has gone up dramatically, okay? But that alone won't cause inflation. The second thing that has to happen is what's called velocity of money, meaning how quickly money is exchanging hands. So Lexi, I give you $100 for hosting this website. You then go out and spend 90 of that $100, put 10 bucks in the bank, and then whoever you gave that 90 to, they go out and spend 90% of that, and so on down the road. What we saw after the Great Financial Recession is all the money just stuck in the banks. So people really didn't increase the spending velocity of their own accounts, okay? So that could happen again in this situation. And in fact, most of the stimulus money, especially what the Fed is doing, that's all essentially sitting in banks, okay? So that hasn't really leaked out. So the leakage here is, those $1,200 stimulus checks you're supposed to get, these PPP loans, et cetera, and that could ignite inflation. And theoretically speaking, it should. But the question then is how quickly those people exchange those dollars. How quickly are they spending those dollars? And the best example is like, hey, let's say we lift everything's great, vaccines come out, and you have a massive line outside of Target to buy whatever it is, right? That will spark inflation, basically. But if people are slowly going back to Target, even after the liftage, you probably aren't going to have that much inflation. The other thing, part of inflation is commodities. Commodities have, the price of oils right around $20 a barrel right now. I think I've filled up, and I don't fill up my tank often these days, but I think I filled up for $1.44. So the cost of producing goods, it has gone down, right? Energy prices have come down, oil prices have come down. So companies in general aren't going to be willing to raise their price, which is what leads to inflation, real quick, because what their first thing they want to do is get people to come back to buy their goods, right? And you don't want to raise your price if you're trying to get people to buy your goods. That said, so I think in the short run, we don't have a lot of problems. I think in the long run, to the questioner's point, yeah, you could see inflation. When that happens, I don't have a good sense of what that is, because again, we don't know how long this slowdown goes on, basically. So that's a great question, though. What about small investments? $4, right? So they're, you know, in general, we typically invest like a cheap index fund, essentially. I don't want to throw out tickers, but SPY or something that tracks the S&P 500. If you're thinking about investing small dollar amounts, we think it's very hard to pick individual stocks just because there's sentiment around there. And I've put up, real quick, I put up our blog. I think that's a good resource you can go to kind of think about the way we think about investing. You got our actual Engaged Financial Group website up there. And then you can shoot me an email if you want, if you have specific questions. But as far as small dollar amounts, you want to try and diversify that dollar amount across as many, you know, companies you can. And basically the best way to do that is in an S&P 500 index fund, if you're thinking about stocks in particular. And all of the online brokerage houses have gone to $0 commissions at this point. So you could open one up at TD Ameritrade or Charles Schwab or whatever it is, or I know with millennials these days, it's Robinhood. That's a big app that everybody's playing around with. So there's multiple ways, and it's super cheap to invest these days. Any other questions, Lexi?
I don't see any right now. Does anyone else have anything they want to ask?
John seems awfully quiet. I've never seen him sit for an hour and not say anything.
You have to unmute yourself, John. You know how to click on the right corner.
There you go.
There.
Now I'm taking it all in, Kris. So I'm learning a lot today.
He's figuring out how I can retire.
I'm thinking, yeah. No, they were good questions, and we all wish we had a crystal ball. So that would be great. When to put your money back in the market or add to it. But
yeah, it'd be real easy then, right? Like, yeah. But nobody has a crystal ball. I mean, look at Warren Buffett. You know, the guy made his money over years and years of investing, right? He's got great philosophy, one of probably the greatest investors of our time, but he's not 30 years old, right? I mean, it takes time to work the market. And in the long run, like I said, the fundamentals drive the market in the long run. In the short run, though, we have these biases and sentiment changes, and that's all driven by like a system where we're just one day we wake up and we think the market's great. The next day, you know, the market starts to go down and we regret. There's another bias called regret bias. Regret jumping in, and then we make irrational decisions, essentially.
I mean, would you advise people, like we've always just, you know, you put your money away every paycheck or every month, and so, you know, we bought a lot of things high this last year, and just stay the course. If you were putting $100 a month away, if, you know, consistently, don't change that right now, because you're probably buying low, but who knows, right?
Yeah, no, that's a great question. So really what you want to do on an annual basis is typically rebalance to your specified allocation. So for, you know, the moderate investor allocation is 60% in stocks and then 40% in bonds. And then you can break it up from there, you know, international stocks, emerging market stocks, bond side, you know, treasuries, whatever it is. But when you have a year like last year where the market did really well, you know, at the beginning of the year, you want to rebalance and try and get your mix back to 60-40. So, for example, if you had a 60-40 at the beginning of year last year, at the end of the year, you're probably closer to 68% in stocks and 32% in bonds. Well, if you rebalance, you would have sold some of that high stuff at that point, right? And reduced your risk, so to say. And then the same thing when the market came down. So we started doing rebalances in March to get our 60-40 allocations back into the market at that point, right? So to your point, we're buying the stocks at a lower price, right? So that's really the thing you want to try and do in the intermediate term. But really the best advice, and I think you kind of hit on it, Johnny, is you shouldn't really even look at your statements, okay? Unless because you are going to become susceptible to all of these biases. You know, my wife just got her quarterly statement, and she lost a bunch of money, as a lot of people that had a bunch of money in stocks. And, you know, she was harping on me about, you know, doing something about it, right? So that throws off your long range goal, basically, because if you think about it, hey, if I pull, you know, the market goes down, I pull all my money out of the market. This is a hypothetical. Well, what I've done there is I've locked in that minus 30% loss, right? Like I'm realizing that 30% loss at that point. So if I take that money out, what am I going to do with that money in today's? Am I going to go to the bank and put it in a savings account? What's the savings account rate that you're getting right now? 0.1%? Like, how long is it going to take you to recover that 30% loss? Like ages, literally ages to get back, right? And so if you follow my prescription in the sense that, hey, I think the market in the long run, this historically is proven out. The market in the long run is just based on us buying stuff from Coca-Cola, Pepsi, you know, McDonald's, going to Walmart, going to Target, Diane, whatever it is. You know, those are all companies listed on the market, and they're all there willing to sell you stuff, right? If you do believe that fundamentally our psyche changes because of the virus, and that we will reduce our spending for the remainder of our lifetimes, then yeah, you probably want to play around and try and figure out another way to invest your money. But you know, people often forget the great financial recession of 2008. Like, you know, I was in it. We were having PTSD when all this stuff started happening, right? Like, I thought that was actually worse than what's happening now. Like, what's happening now is a health scare, and yes, it is an economic scare. But the government and the Federal Reserve has really jumped out in front of this, and they've really pumped in a bunch of money into the system to try and stabilize stuff. They are, you know, I think personally they did a great job with the CARES Act and how they structure that. We can all armchair quarterback that after the fact, but the initial stimulus that they're throwing in, it will take time to work through the system, but I think they're ahead of the curve in what they did, basically, okay? And so I think that helps stabilize these things going into the future. So I guess to answer your point, yeah, Johnny, either rebalance or, you know, don't open up the statement unless you allocated incorrectly in the first place. Then you should probably come here and let me take a look at it. But, you know, in general, the allocations are typically fine. It's you going in there and seeing that loss and then saying, you know what, I'm going to reduce my exposure to stocks and put it in bonds because these things are safer. Well, what you did there is you just sold at a loss, right? And you realized that loss. But that money, you're not going to use that money for another 20 years, right? So what's the probability of that money coming back in 20 years? It's pretty good, historically speaking, right?
Right.
Hey, Kris, it's Jason. I don't know if you can hear me or not.
I can.
Okay. Hey, great presentation, by the way.
Thank you.
I got a very loaded question. I've always wanted to buy the blue chip stocks, but, you know, they've always been traditionally pretty high. Is now a good time to buy the blue chip stocks like Apple? I would assume Disney's way down. Coca-Cola, those kind of companies?
Yeah, so look, when we allocate clients' accounts, we typically use ETFs and or mutual funds. We're skewing more towards ETFs. We don't tend to look at individual companies, okay? And the reason is we have all these investment firms come in to our office and pitch us on their investment prowess and stuff like that. You know, Goldman Sachs comes here, Wells Fargo, JP Morgan, and they show us their investment portfolios, the mutual funds, the ETFs that they have. And when we run them, essentially trying to evaluate them, they typically don't do any better than a dummy S&P 500 portfolio, okay? And what I gleaned from this is I said to myself, look, you know, I've got 2 computer screens here. What does Goldman Sachs have? They have hundreds, if not thousands, of computer screens. I'm just one chartered financialist here. Goldman Sachs has 500 of me and 500 PhDs on staff, and they can't seem to beat the market by picking individual companies and putting them in portfolios, right? So I've kind of skewed away. If you go to my my blog, actually, I've got a couple of good papers on there about trying to pick individual stocks. And I do have clients that want to buy individual stocks. And I tell them, look, you go out and do it yourself. And I don't have a problem. But what you need to do is focus on those biases. So to your point, you know, if you're going to buy Apple, great company, great cash flow, I'm fine with Apple, right? I'm fine with but Disney's probably Disney's got some other extenuating circumstances right now. But let's use Apple as the example. I do believe that Apple is a good stock. Now, whether this is the entry point you want to get into, I don't know. I can't really say it. But if you say, hey, I'm going to buy Apple and I'm going to hold it for 5, 10, 15 years, I don't have a problem with that. If you want to try and play, you know, the short-term game of, hey, maybe Apple goes back up and I sell out, I don't know how to evaluate that. And honestly speaking, a lot of professionals that do this on a daily basis don't know how to do that. I mean, we've looked at the data, and it's very hard. So I would recommend, if you want to play blue chip stocks, go and find a blue chip ETF, something that, you know, you're gonna get a bunch of different of those blue chip companies within one wrapper, right? And that way you mitigate some of the idiosyncratic risk, meaning the individual company risk inside of there. Unless you're very committed, unless you you really follow that particular stock, you know, go have at it. I don't have a problem with that. I just typically try and shy people away from trying to bet on individual securities, just because I know the professionals themselves have a very difficult time at it. But Apple in particular, look, you know, great company. I don't have a problem. Here's one thing we've looked at. You know, the best. You know, there was 2 stocks that were thrown at a recent conference I went to, and it was Google and Domino's. And since their IPO, Domino's has actually done better than Google. Like, who would have thought Domino's did better than Google? But I mean, that kind of stuff happens, right? But if you're like, hey, I'm comfortable with a 7-8% return, then and you can plan on staying in there with Apple, then yeah, I'm fine with that. But I hesitate to, again, give individual stock advice because I myself have trouble analyzing those things.
Okay, thanks.
Yep. Any others, Lexi?
I don't see anything.
Perfect. So again, the blog site's up there, the website, my email address, phone number. Reach out if you got any additional questions. But I think I'm good.
Hey, Kris.
Yes.
Hey, it's Elise and Kris Nashala. We're tuning in and
Hey, Elise.
appreciate your input here. So thanks for answering our question about inflation and really appreciate what you've passed on today.
Hey, I appreciate your work on the Boone County government, right? Yeah, council.
Council.
I just drew in I was gonna say Boone County Chamber, and then I was like, that's probably
That
not.
too. She's a chamber member.
Yeah. No, great. Thanks for joining in.
Thank you.
Yeah, it was good stuff. Definitely.
Oh.
And you nailed me on the roulette example.
Yeah, look, The
Like
casinos
talking to me.
know it, right? That's
Yep.
literally why they put that thing up there.
Oh,
is-
yeah.
Because they know you're going to go in there and say, hey, it's red, 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 black, red, 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 black, red, red,
Yeah.
red. Oh, I should probably put my money on black. But again, that ball that's spinning around on that wheel has no idea what was previously spent, right? Like,
Yeah.
it's just, it's the nature of our system one
Yep.
brain thinking.
Yeah.
And so much of this is emotional. I did not open my statement. John did. But I told him to not show me. Why did you show me that?
I wouldn't have opened it if you didn't ask me to.
I did not.
You could have both just stayed
It's
in.
all right. It's all right. I don't open it too much when it's high, and I don't open it, it's.
Well, and I think that's kind of the biggest takeaway today, I believe, is, this is not something we can predict. I mean, it can be predicted, but we don't know what's going to happen. So we have to have confidence in the longevity and not kind of buy into that fear of the unknown, being aware and educated, which thank you so much for providing us, with that information, because that's what we want to do is, really be educated and have that guidance, but know, as John said, there's not a crystal ball. So
Yeah.
if we can all believe in kind of the history of this and knowing the longevity, I have confidence that we will rebound and hopefully stronger than ever, and just, eliminating the fear, of folks, giving them the confidence to know the history of this, and, in that 20 years from now, that we will be hopefully stronger than ever.
Oh, I believe we will, I mean, my wife hasn't budged. Every time we drive by a holiday farm, she still wants to buy a house in there, right? Like,
There you go.
I mean, it's just nature to buy bigger and better things. And again,
And I think the economy, everybody from, being at home will be, aware of their finances, because a lot of, almost everybody's going to have to do that. But everybody's going to be so excited to support our local businesses and our restaurants. And, I see that, our restaurants of Boone County will have lines out the door, and our, retailers, because people want to get out. They want to be together. They want to not cook every, meal. And really, meet their friends out of the local restaurant. So that's what we're looking forward to, the time that, we're able to do that, which will in turn, help our local businesses also.
Yep.
Any other last questions? So again, thank you for joining us. There will be a recording. Lexi will send that to everyone that registered for this. It will also be on our newsletter that we distribute weekly. So if you're not getting those newsletters and would like to get on that email list, just send us an email at info@boonechamber.org, or give the chamber office a call. We do get those messages remotely. We're working most times remotely also. So we will respond back to you, and we will get that your email listed to get that information. And if you have any additional questions, that you think of after this webinar, just feel free. Again, Kris put his contact there. Give him an email or give him a call, and he'd be happy to help you.
Yeah.
Right. Thank you.
Thanks,
Thank you.
Kris.
Thank you.
Thanks, everyone. We'll see you Friday, 10 a.m.
Bye.